initially for 5 minutes for questioning. Mr. Carney, this committee has repeatedly advocated for the federal banking regulators to tailor regulatory thresholds rather than operate under a one-size-fits-all framework. This ensures that a small bank in rural Kentucky is subject to a set of standards that reflects their own unique size, complexity, and business model. What has been the result of regulatory thresholds remaining static while the economy and banking sector grows?
So as banks grow, we see what we refer to as regulatory drift, and indexing would allow for a more consistent risk-appropriate framework over time. And a static threshold, what it means is as a bank approaches that threshold, they are looking at potentially increased compliance costs if they cross that threshold. So they begin to defensively manage their balance sheets to try and stay under that regulatory threshold, or do what we refer to as jumping a threshold, which is an acquisition to spread those increased compliance costs over a larger institution. That's not appropriate. That's not a way of, it's far better to let a bank grow organically, continue to fund loans in their communities rather than be forced into those two situations.
Yeah, I've heard from banks in the $9 billion category especially because of Durbin and other regulatory pressures that trigger up and CFPB supervision at 10. They want to jump really high and really fast in order to deal with that. So indexing these thresholds would create a more dynamic and flexible framework that would keep pace with economic realities?
That is what we're recommending. We're recommending indexing to nominal GDP, which captures the values of goods and services provided.
Okay. Yep. Small and mid-sized banks rely on access to diverse sources of stable funding to remain competitive. You all testified to this. One of the funding streams is reciprocal deposits, where banks place deposits into a network between multiple banks, exchanging customer deposits with each other in amounts below FDIC's coverage limit. These reciprocal deposits offer a valuable tool for protecting depositors and promoting financial stability by allowing banks to offer full FDIC insurance on large deposits while keeping equal funds at their banks. Removing barriers to their use would promote depositor confidence, strengthen funding stability, and enhance overall financial system resilience. I was proud to co-sponsor Majority Whip Emmer and Congresswoman Beatty's bipartisan H.R. 3234, which would modify the amount of reciprocal deposits that are considered to be non-brokered, permitting greater use of this stable funding source, especially for community banks. Mr. James, you noted in your testimony and in a letter that you support this bill. Can you briefly talk about how Carver State Bank uses reciprocal deposits and why they are important to your institution?
Mr. Chairman, thank you for the question. Just before I came into this hearing room, I had a call with a large Wall Street bank that has made a deposit in our institution. Our bank is headquartered in a census tract with over 60% poverty. There is not a lot of spare cash lying around in that community for us to deploy to grow businesses or make consumer loans available. I was fortunate that the institution that we have this relationship with, which is using a reciprocal deposit product, decided that because of the impact that we're having in the community, they want to increase the amount of that deposit. Those funds will be made directly available to underserved urban and rural communities all across the state of Georgia and now into Alabama as we've acquired an institution there. It's very important that we be able to in-source capital from higher net worth individuals or corporations or municipalities in order to make capital and credit available in the communities that we serve.
Yeah, that's a great example. Mr. Barresi, could you explain how increasing limits for well-rated financial institutions before reciprocal deposits are considered brokered could support community banks in securing stable funding?
Thank you, Chairman. Sure, absolutely. There are institutions all over the country who are heavily reliant on relationships with partners or large depositors where they need the ability to use an intra-fi or similar system for reciprocal deposits to be able to fund their activities. Increasingly, those enterprises do business with partners that are subject to scrutiny under systems that essentially penalize those deposits, and it impairs their ability to have consistent and stable funding. So flexibility on reciprocal deposits is crucial for smaller institutions to be able to fund the activities in their communities.
My time is expiring, but on a related note, the regulatory treatment of broker deposits has been in limbo since the Biden-era FDIC moved to rescind a framework implemented under the first Trump administration. So it's important that Congress restore stability in this broker deposits regulatory regime.